All right, everyone, let's jump right into one of the most important accounting standards for your exams, AS 11, all about foreign exchange rates. We're going to break this down piece by piece so you can absolutely nail any question that comes your way. Let's get to it.
So let me start by throwing a classic exam trap at you, one where so many marks are lost. Picture this. Your company buys a huge machine from the US, and you get a dollar loan to pay for it. But by the time you have to pay, oh no, the rupee has tanked. This creates a massive exchange loss. The machine has basically cost you way more rupees than you planned. So the question is, can you just add that loss to the cost of the machine? What does your gut say? Now, it feels logical, right, to just add it to the cost. But AS 11's general rule is a big, fat no. That loss has to go straight to your profit and loss account, which can make your profits look a lot worse. But, and this is a huge but, there is a massive exception to this rule. And let me tell you, ICAI absolutely loves to test this exception. We're going to dig deep into that because it's one of the trickiest parts of AS 11. To make all this real, let's work through a problem just like you'd see in your exam. Meet Rotomac Ltd. They've got two classic Forex issues. First, they bought parts from Germany for 50,000 euros. Second, they have a sales office in Dubai that pretty much runs itself. Your job is to figure out how to get all of this into their Indian rupee accounts. This scenario is perfect because it lets us cover the two main parts of AS 11.
Okay, let's do this. Before we can solve Rotomac's problems, we need to understand the basic rules of AS 11. Think of this as learning the rules of the game before you start playing. You gotta know the battlefield to win.
So what does AS 11 actually do? Well, it really has two main jobs. First, it tells you how to account for individual transactions in a foreign currency, like Rotomac's purchase. And second, it tells you how to translate the entire financial statements of your foreign operations, like their Dubai office, back into your home currency.
Now, this is just as important, and it's a place where people get confused and lose marks. What does AS 11 not cover? It doesn't deal with the cash flow statement. That's a job for AS 3. And it doesn't apply when you're just doing a convenience translation. Just restating your financials for a foreign parent company. That's a whole different thing. Okay, listen up, because this next part, this is the absolute heart of AS 11. The difference between monetary and non-monetary items. If you get this concept, you've pretty much won half the battle. This is absolutely crucial. So, what's a monetary item? Think of it this way. It's anything that has a fixed price tag on it. The key phrase here is fixed or determinable amount of money. You know exactly how many dollars or euros or whatever you're going to get or have to pay. The classic examples are things like cash, debtors, creditors, and loans. The number is locked in. And non-monetary items? Well, they're basically everything else. Their value isn't fixed. It's, a bit squishy. It can change. Think about your inventory or a fixed asset. How much cash is it worth? You don't really know for sure until you sell it. Same thing with investments in shares. Their value goes up and down with the market.
Let's make this super clear with a quick practice round. Look at this table. Inventories, non-monetary, because their value can change. Trade receivables or debtors, that's monetary. You're owed a fixed amount. Investments in shares, non-monetary for sure. The value's all over the place. And property, plant, and equipment, also non-monetary. Nailing this classification is step 1 in any AS 11 question. Seriously, don't move on until this is crystal clear.
Okay, great. Now that we have our key definitions down, let's put them to work. We're going back to Rotomac and that 50,000 euro purchase they made. This is a perfect example of a foreign currency transaction.
The accounting for this stuff follows a really simple 3-step process. Just remember this: record, remeasure, and recognize. First, you record the transaction using the exchange rate on that day. Simple. Second, at the balance sheet date, you remeasure any outstanding monetary items at the closing rate. And third, when you finally pay up, you recognize the final gain or loss.
Now let's really focus on these golden rules for the balance sheet date, because this is where students often get tripped up. Here's the main thing. You have to retranslate monetary items, like Rotomac's creditor, at the closing rate. Why? Because their value in your home currency is constantly changing with the exchange rate. But for non-monetary items that are carried at cost, like inventory or machinery, you just leave them alone. They stay at the rate from the day you bought them. Their value is in the physical thing, not the rupees you paid. Remember that difference.
So, all these little gains and losses from retranslating, where do they go? Straight to the profit and loss account. Boom! Right on your bottom line for that period. You can absolutely bet the examiner will test you on this, so highlight it, star it, do whatever you need to do in your notes.
But wait, just when you thought it was that simple,
bam, there's a twist. Remember that question I asked at the very beginning about capitalizing the loss on the machine? I told you there was an exception. Well, here it is. Paragraphs 46 and 46A. This is a huge plot twist that you have to know for your exams.
Okay, deep breath. This exception only applies to long-term foreign currency monetary items, and it's an irrevocable choice, meaning once you choose it, you're stuck with it. So if that long-term loan was to buy a depreciable asset, you can add or deduct the exchange difference from the asset's cost. This is the answer to our first question. For any other long-term items, the difference goes into a special account, the FCMITD account, and you spread it out over the item's life. It's a powerful tool, but remember, only for long-term items.
Phew, okay, we have totally nailed foreign currency transactions. Now let's switch gears and tackle the second part of the puzzle, Rotomax sales office in Dubai. This is a foreign operation, and that means we need a different set of rules.
The very first thing you have to do is classify the foreign operation. Is it an integral operation, which is basically just an extension of the head office, or is it non-integral, meaning it's pretty much a standalone business? We look at things like who provides the financing and what currency the sales are in. Since Rotomax Dubai office is self-sufficient, that's a classic sign of a non-integral operation.
Now, just for a second, let's imagine the Dubai office was an integral operation. If it were, the translation rules would look super familiar, right? It's pretty much the same as how we treat our own transactions. Monetary items at the closing rate, non-monetary at the historical rate. And the key thing, the exchange difference would go straight to the P&L account.
But since the Dubai office is non-integral, the rules are completely different. This is a huge deal, so pay close attention. Instead of hitting the P&L, the exchange difference gets parked in a special reserve account on the balance sheet called the Foreign Currency Translation Reserve, or FCTR. All assets and liabilities get translated at the closing rate, and the difference goes to this reserve. This is a major difference and a classic exam trap.
We are in the home stretch now. We've covered the really big concepts. Now let's talk about the finishing touches, the little things that will take your answer from just okay to full marks.
Here are 3 last points to lock in. First, if you have forward contracts, you have to spread the premium or discount over the life of the contract. Second, don't forget about taxes. Any tax effects fall under AS22. And third, and this is super important, remember your disclosures. You have to state the amount that hit the P&L and show a reconciliation of your FCTR balance. These are easy marks, so don't throw them away.
So let's bring it all home and solve the Rotomax case. For that €50,000 purchase, the exchange difference hits the P&L. For their Dubai office, which is non-integral, the difference goes into that special FCTR reserve. See? It all comes down to knowing which bucket to put the exchange difference in, and that totally depends on what you're dealing with.